Markets are surging, which usually makes people freak out. They're worried about some type of a bubble or whether the growth we're seeing is sustainable, things along those lines. So I want to go over these two articles from the Wall Street Journal, this one about productivity and then this other one about low-income workers. Now, this one gets way down into the weeds around productivity and inflation and kind of where the markets have been. It's excellent, but I want to take 5 minutes or so to cover kind of the basic concepts of what it's talking about. I think is very important to understand what's going on with current market growth. And we're going to start with supply and demand. So in America, if we eat 100 sandwiches a day, then we will generally produce 100 sandwiches in our free market. Lots of companies will be competing, buying materials, and then trying to outcompete each other on price. So that the price of the sandwich is generally going to be slightly higher than the material costs of the sandwiches so that they can still make a profit. And if demand goes to 105 sandwiches a day, then the sandwich producing companies will start making 105, and they'll make about 5% more profit because they'll just build more factories, hire more people, buy more sandwich materials, and make 5 more sandwiches a day. But what if sandwich demand gets to 125 and the capacity of America to make sandwiches is only 120, meaning for some reason they can't make more factories, they can't hire more people, there isn't enough materials to buy to make all these sandwiches. Well, the price of sandwich will start surging until the demand comes back down to 120 because they can only make 120. So obviously only 120 are going to get bought. And this is what causes inflation. A lot of people inaccurately think that inflation is like this inevitable thing that if there's just more money in the world, then everything's just going to cost more. And these days, the amount of green dollar bills in the world really has very little relevance on anything. Virtually everything is done electronically. And while the Fed does kind of control the monetary supply through their quantitative easing and tightening schedules, it's still in this world of just because there's more money in the world does not necessarily mean that everything should cost more. Now, it's very complicated once we get past this, but so kind of going back to this example, if demand outstrips capacity, then this is when the price of those sandwiches will start going up, even though the cost of the materials has not gone up. And you might think, oh, that's great for the sandwich manufacturers, but inflation has a way of working itself through the economy is that all of a sudden now the prices of everything has increased. Not only do your supplies start costing more, but your labor costs more because they expect more money because their cost of living has gone up. And this is the nasty kind of bit of inflation that we have been trying to control for the last 2 years by increasing interest rates to make consumption smaller, right? To try and make it so that we're not buying quite so many sandwiches so that we can eat the 120 that we're making and not try and buy more so that companies have time to catch up. And eventually they will, right? And they have 2 options to now make the 125 sandwiches that people actually want to buy. The first is the old-fashioned way. They buy more factories, hire more people. And in that case, they will make more money, but they'll still just make kind of a percent. We're going to make 5% on whatever the cost of the sandwich is. The other way is they can make the current factories and current workers more productive. They can take what they have now and figure out a way to make more sandwiches out of it. Maybe they get a new slicer that was the bottleneck, and they can make more sandwiches per day now. And in this is productivity growth. And this is what this article is talking about, that productivity growth is generally better, more sustainable growth that can be, be a little alarming when you see growth as fast as it is. And the 2 reasons that, this article largely attributes it to, one is artificial intelligence. Artificial intelligence, I've said many times, is to white collar work what the tractor was to agricultural work 100 years ago. It's just making everything more efficient. And we are just on the cusp of it. If you're kind of like, I still don't get this artificial intelligence thing, like why is it even useful? That's because we are just starting to understand how to use it, how to unlock its powers and things like that in business. And then the other one is really coming out of COVID. Recessions, downturn, nasty economic events have a way of making companies stronger. They do more with less because they are forced to. Yes, some of them fail in that process, and we saw some of those fail in COVID, but the remaining ones are typically more productive. So that's kind of the other source of production. Now, the other bright point is this one, which is when we were coming out of COVID, COVID labor was in hot demand because a lot of people just decided to retire, right? This was the great resignation that we talked about back in 2021 and 2022. That had ripples through the labor market. Wage growth was really good, but then right on its heels came the inflation we saw in 2022 and in 2023. And the worry was that that inflation would erode all of the gains that we had seen for lower income workers. And lower income workers are extremely important to economies because they spend almost everything that they make because they need to. And inflation is so much more impactful to them because if your average person spends 50% of what they make on their actual needs, food, energy, housing, things like that. 10% inflation, now they're spending 55% of what they make on their actual needs. Not that big of a deal. Someone who's spending 80% of their income on what they need, 10% inflation now makes it 88%. It's a much bigger impact to their quality of life. And what this article is really going through and saying that most of the gains that we have seen for lower income workers we have sustained it through. There's a number of great graphs in here, and that this is like good long impacting gains that we've seen in lower income workers, which is good for the economy, not because we are a bunch of altruists that are just trying to help people that are less fortunate than us. It's because it's actually good for the economy, right? We have largely over the last 40 years debunked supply side trickle down type economics. If you want your economy to do better, focus on those at the bottom of it. All right. And then I'll also link this one. This is just the other side of the story, right? I can't just be super positive and not give you some drowsy or some downer news. I will link this. This is talking about your standard, are we in a bubble type information. Now, if you want a unique perspective on this, when we were still recovering last year, I did this video going over a number of charts and kind of debunking the panic that was occurring then. The same thing like, we can't sustain this growth, even though we still hadn't even gotten back to where we started on the stock market. And it kind of goes through that. So if you want a kind of interesting perspective as to what we were talking about 6 months ago compared to what we're talking about now, I think it's worth a watch. I hope this has been informative. I will talk to you soon.